Hello and welcome to FX Acrobatics. I am the Acrobat and today we'll be having a look at premium and discount. This is part 4 out of 10 of the market structure series. To be specific, institutional market structure. Alright, let's get down to business. Alright, this is the Canadian dollar. This is the weekly chart. As usual, it doesn't really matter. The rules apply on all time frames. Alright, so let's talk about premium and discount then. First, let's observe what's happening here. I am using a tool called the Gain box and I've removed everything else. I just want to see 50% of the range where we call that equilibrium, and anything above 50 is premium and anything below 50 is discount. So the idea is when you divide what we call a dealing range from this high, this is a swing high, as you can see, this candle here is lower than the high here, and this candle's high is also lower than this one. So this is a swing high, and then you have a swing low here. Now from this to that, you get that swing low here, and this is called a dealing range. So when price is below the dealing range, of course when the swing low forms, when price is below that swing, that 50% mark here, that is your discount. That means when you want to buy, ideally you'd like to buy on a discount, and when price is above equilibrium, that's premium. So ideally you want to sell when price is really expensive, so that you can make much profit. Obviously that's the concept. That's all. Let's have a look at another example right here. So from this high to this low, that's your dealing range. So ideally you want to place your buys below this equilibrium point. So price is cheaper here. The idea that price is now oversold, so ideal buys can occur here. I hope you understand what I just said. As the price is oversold here, so you don't need an indicator like Williams %R or the RSI to know that price is overbought or oversold. You just need to know the dealing range, the last swing high, the last swing low. So when this candle is confirmed, when this one closes, that this is a swing low, you already have a swing high here, you already have a swing low, you have a dealing range. Anything below here is discount, anything above here is premium. So it gets very dangerous for you to start buying above here, because chances are price will start to move in the opposite direction, and it does. See, as soon as price goes above the 50% mark, it starts to retrace. So if you bought here, you could be in hot waters. Let's observe that a little more. Swing low, swing high. If you buy anywhere here, chances are you'll get slaughtered because price comes down. If you sell below the 50% mark, you could get slaughtered because now price is oversold and it might just want to go up. Here price at this point is overbought and it might just want to go down. See that? So be very careful there. Same thing, swing low. That's the swing high. This is the swing high. So you don't want, after the swing high forms, you don't want to be selling anywhere here. You want to be looking for buys when price comes down here. So that's why when you use the Fibonacci, you'll have your 62% retracements and all of that to get the optimal trade entry. That's because you have your low, your high, and you wait for price to go to a point where it's at a discount. So that's below equilibrium, and 62% retracement is really, really deep. So you can start to look for reasons to enter the market here at a discount. All right, same idea, swing high, swing low. That's all you do. Whenever you see, when this candle closes, this one, you just plot this thing here, you divide, and you know that you can still buy anywhere here. And when you find a reason to get into the market here, look at what happens for you. Right, it doesn't matter. See, I just moved the dealing range from this low to this high to cover a bigger range, like that one, from low to high. Look, comes down below equilibrium, you get your discount here, and you can buy and go up. Simple like that. From this low to this high, discount. From this high to this low, premium. So you can sell above here. See, from this high to this low, you wait for it to retrace above equilibrium, find a reason to enter somewhere here, because price will most likely start going down, and it happens 95% of the time. It's very important for you to go and look at these things in the charts and practice them. All right, this is the Canadian dollar. This is the daily chart. I just wanted to point out that this thing happens on a daily chart or on a weekly chart or any other chart. This is a swing low, that's a swing high. Didn't quite get there. That's very important. Just wanted to show that 95% of the time I was talking about, those things sometimes might not happen. There are reasons for that. If you can see that this is a swing low and that's a swing high, that's a dealing range right there. So don't think that it doesn't hold. It might be that you didn't read it the correct way. All right, so you see, I can already show you. See, just the 50% mark just below, right, the equilibrium, and it goes up. So yeah, same thing here. Never swing low, never swing high. Discount, you can buy there. Even if I stretch it from the same point all the way to that, the concept still hold right there. Swing low, swing high, it comes back here, it reacts always. Swing high, swing low, goes to premium and sells off. Swing high, swing low, premium and sells off. All right, let's have a look at this indicator here, the Hull moving average, which I have drawn into the chart. So sometimes people trade the strategies that like revision to the mean. So you want to get in when price comes back to that, or you want to buy when price is above the moving average and sell when price is below the moving average. Sometimes there's a lot of ambiguity on when to enter in those cases, so you can use this for a case like that, but really moving averages can be really bad. So here you have the high moving average telling you that right here you can do your bias revision to the mean, which is good and all. It holds here, moves, is your dealing range, it comes back into equilibrium. Also at the same time it touches the high moving average. You can use that, you can get a good trade out of that. Same thing here, goes from here all the way up there, but unfortunately now price is below the moving average, so most of the strategies would have you not touch this anymore because they think it's bearish, yet it's just going into a deeper retracement from this low to this high. The dealing range is quite wide and it retraces to below equilibrium, and there you go. A better use case maybe would be to use the super trend. It's a fairly good bias indicator. See there, you can look at trades like this. This is a bullish case using the super trend, and you have a dealing range from this low to this high. When you start to see price retrace, you can put in your dealing range from this low to this high. Optimal trade entry somewhere there, maybe 62 to 79% retracement. You already know that you're at a discount, and then you can buy in and probably win the trade. I'm not giving you a strategy, I'm just saying it's one use case. Here's another example, bearish case, dealing range from high to low, price goes into premium here, and your super trend is agreeing with you, goes in there, and look at that, there's an order block right there. Confluence, who knows. All right, more examples. Even if you take it from this high to this low, still get a deeper retracement. All I'm trying to say is that the dealing range, most of the times when you get that 50% mark, you get that confluence. Let me just take this back a little bit. See, we're moving from this high to this low, but let's say maybe you are not using that high, so you are getting in here because this is now in a premium and it's hitting an order block when you have a bearish case using your bias indicator for whatever reason. But let's say now you want, maybe you take your dealing range from this high, so swing high, to this very same low right there. See, from there to there, the idea is still the same. We are above premium, we are above equilibrium, and we hit an order block when we are bearish. It's the same thing, right? I hope you find this insightful. On the next series video, we'll be talking about the break of structure and market structure shift, the difference between the two and how they can be used. Until we talk again, this is the way.